Hey everybody, welcome to Everything Accounting. I'm Alfred, your friendly neighborhood CPA, and today we're going to be talking about analyzing your financials. So, a lot of companies will bring me in to analyze financials as their CFO. That's typically what a CFO's role is to really analyze the financials, find ways to make things more efficient, and make sure that you're managing the cash flow and the profitability to maximize the growth of the business. So this is obviously a big topic to discuss. So there's going to be multiple videos regarding this, but I wanted to start off on the simplest basis of what I analyzed first, which is your gross margin. Now, to get your gross margin, that's essentially sales minus cost of goods sold or minus cost of sales equals your gross margin. So what falls into gross margin, or what falls into, more importantly, cost of goods sold or cost of sales, is the direct costs attributed to your sales. So if I'm analyzing a business's services, so let's say an accounting firm, always the best example given that I'm an accountant. When I'm analyzing an accounting firm's cost of sales, your cost of sales are essentially any direct labor that's going into it. So any way that I can attribute the actual labor going into dealing with clients, any software costs that are directly attributed to the businesses, and any real direct costs associated to helping businesses analyze their financials. For simplicity though, let's use a cost of goods sold method to discuss. So let's say you have company A is selling product A. Product A costs $20 to make and they sell it for $100. If we're analyzing from the simplest terms, gross margin then is $80 per unit, which is great margins. Unfortunately, the reality, and with real life situations coming into play, it's never going to just be one cost. There's going to be multiple costs that attribute making up the product or creating the product to sell. And unfortunately, those prices, given real world examples, change and fluctuate all the time. So when we're looking at your cost of goods sold, the simplest example of, say, a wine bottle. We're selling one bottle of wine. To produce a bottle of wine, you have to have grapes, you have to have the winemaking process, you have to have the additives, anything like that. So that's all listed. Then you have the bottle, the label. Then you have shipping for that bottle. All of these items come into play into producing or selling that one bottle of wine. So when we're looking at your cost of goods sold, we have to take all those into account, because it's not as simple as, hey, I'm going to buy this one piece and basically build it out and then produce one product. You are buying multiple pieces, multiple costs of goods, essentially, to build and produce that one product. So managing your costs on those comes into play quite a bit. Now, your gross margin is really important when we're analyzing your financials, because if, for whatever reason, your gross margin is negative, then instantly we know there's a problem. We know that there's no way your cost of goods sold should be higher than the sales that you're bringing in. The only reason why that would be happening is your cost of goods sold went up so high and you didn't account for that in the sales numbers. So analyzing your financials, I want to see your sales being at a number and your cost of goods sold being at a much lower number, because that gross margin is what you're going to be using for all other expenses. So that's like rent and advertising, any meals and entertainment, any office expenses, anything along those lines. Even your taxes fall into that line. So it's really important that when I'm analyzing financials and when you're analyzing your financials, that we break down your cost of goods sold or your cost of sales to be a much lower margin. Now, some people and some accountants like to lump in cost of labor before they lump in your gross margin. So it is actually a very smart way to do it, depending on what the labor is. So if your labor is directly attributed to the sales, then yes, absolutely, let's account for that. If it's not, then I would apply it as a different line item. So in the winemaking example and making that bottle of wine, how much labor actually went into producing the wine? So I'm not talking about the management or the accounting or the marketing team that's basically handling pumping out the wine. I'm talking about the people that are actually crushing the grapes, the people that are putting the wine into the bottles, the people that are actually shipping the wine crates out to the different liquor distributors. So these direct costs, or these direct costs of labor specifically, all fall into cost of labor. And then when we're analyzing all over your gross margin, that is what we'll be taking into account. So I always like to use the example of service-based industries when it comes to cost of labor, because typically labor is your biggest expense. You need to have a ton of staff to produce and grow and scale. So when I'm looking at a service-based business and they're essentially bringing in 50% or more on their cost of labor to produce sales, then something's off. I always like to analyze and see, hey, if you're hitting 40% margins on that, then it's healthy-ish, right? Obviously, as sales increase, that margin needs to go down because you want to make sure that your labor isn't going up dollar for dollar. Now, obviously, year over year, you have to account for raises. You have to account for hiring costs, or people leaving, or people coming on, or severance, or anything along those lines that could come up in terms of your direct labor. So making sure that you can maintain, honestly, anywhere between 30 to 40% is relatively healthy for a sales-based business. But the more sales you bring in, the better it'll be, as long as you're not attributing dollar for dollar. So what I mean by dollar for dollar is essentially if I make $100 in sales and I'm spending $50 on labor, that doesn't mean when I go up to $200 in sales that I'm going to have to spend $100 in labor. What you want to do is have a law of diminishing return on that sales increase. So I've hired the maximum amount of people at the $50. And to basically bring in an extra $100, I'm only needing to hire one more person or two more people to bring me up to, say, $80 rather than $100. So with that kind of concept, you're basically analyzing your financials very cleanly and making sure that all in all, you are maximizing your gross margin. So that's typically the first thing that I look at. Now, obviously, like I said, there's a lot that goes into it. There's a lot of analysis. There's a lot of break-even calculations. There's a lot of calculations in terms of your sales that I would have to basically look into. So having a professional help you with this is important. But if you're just starting off in your business and you're just wanting to make sure that you're selling at the right price, analyze your financials. Make sure that you're analyzing your gross margin. Make sure that you understand what your cost of goods are. And a really simple tool, a really simple way to make sure that your cost of goods maintain at a reasonable cost, or your cost of sales, is doing research. So for cost of goods, it's very good to be evaluating your costs. So what I mean by that is not just looking at your financials and being like, hey, I paid $10. It's what do competitors charge for this? What do competitors pay for this? What do different suppliers charge for that same exact product? And if you're constantly doing that research, or you constantly have someone on your team doing that research for you, then every 3 months, 6 months, you can negotiate your contracts. You can negotiate based on contract terms, obviously, but you can negotiate with your suppliers to get better rates. Anytime you sit there and like, hey, I've been using the same supplier for 5 years, they're great, they charge me the same consistently, that's actually not the best practice. It's okay, it's good for relationship building, but it's not the greatest practice for profit growing, because at the end of the day, you can always build up that supplier relationship or negotiate with them to get better rates. As your sales increase, you have more control and you have more value to bring to the table. And thus, when you do that, you can essentially say, hey, rather than paying $1 a piece, at the margins and at the scale that I'm buying at, I should be buying at 95 cents a piece. So that's 5% right there, right off the bat. And that is probably the best tactic when it comes down to analyzing your cost of goods sold. It's making sure that you are buying at the best price point. In terms of labor, understanding the market and understanding the role is very important. So one thing and one trap that people tend to fall into that I find is you value the salary based on the person and not based on the role. So if the role, say, is worth $60,000 a year, but the person that's coming in, you're like, hey, I really like this person. This person's great. I really want them to work with me. I'm going to give them $75,000. And then you do that again and again and again. And now you've increased your margins significantly. You've increased your costs significantly. So it's really important, and it's hard as people pleasers. It's very hard as people-oriented businesses to separate out the person from the role. If the role across the entire industry that you're in is only worth $60,000, then you shouldn't pay more than $60,000. And that's a hard pill to swallow. Now, there's obviously other circumstances where you want to keep this person. You want to make sure that this person's happy. But if giving that person a raise means that you are losing on major margins in your business, then it might be very tough to scale. So always consider that, always review, always make sure that when you're hiring, that you're hiring for the role and not for the person, because it's almost impossible. And quite frankly, it's a rough thing to do to someone to essentially say, hey, we're restructuring your role. And now rather than paying you $75,000, we're paying you $60,000. Most people won't stick around. And that doesn't build employee loyalty to the business. So you want to make sure when you offer that person the role, you're offering a salary that you actually think is achievable and maintainable, because that salary is only going to grow from there. If they start delivering, if they really start bringing in solid work, then you're going to give them raises year over year. So accounting for that is crucial. Again, there's a lot that goes into this. There's a lot of analysis. I've spent years educating myself on this, so you're not going to learn everything from a short 10-minute video. But when it comes down to it, starting off and putting that thought in your head that, hey, I need to actually analyze my cost of goods sold or my sales is huge. So do yourself a favor, start looking at your finances, start looking at your financials, and ask for help from a professional. So ask your CPA, ask your bookkeeper, ask anyone that can really help you out and understand your financials. Ask me. Feel free to reach out. I'm happy to help. Just let me know what you're doing, what you're working on, and I will be happy to go through the analysis with you. But when it comes down to it, trust your professionals, but also trust your judgment when analyzing your business. Anyways, this has been analyzing your cost of goods sold, analyzing your financials. I've been Alfred, your friendly neighborhood CPA, and this has been Everything Accounting. Hope you enjoyed, and looking forward to seeing you guys soon.